The major markets ended last week divided between gains and losses. The indices spanning broader categories and sectors benefited from last week's activity, while the tech-centric NASDAQ and emerging market indices fell. In fact, the losses in emerging markets were enough to push the year-to-date return back into negative territory. The activity across the capitalizations was also mixed. While the S&P 500 managed to generate about 0.75% return, there was even greater gains in the midcap and large-cap value sides of the style box. Yet the growth segment suffered, especially in the mid to small-cap segments. Surprisingly, at the sector level, the gains were fairly evenly distributed, with energy being the only sector to end lower. Real estate, consumer discretionary, and information technology barely managed to close positive, while materials managed to dominate with a 2.68% weekly return. Economic news took different forms last week. On the political front, the Senate passed a $1.5 trillion infrastructure bill midweek that the CBO estimates will add $256 billion to the deficit over the next 10 years. This was followed up with another $3.5 trillion budget plan that passed narrowly along party lines in the Democrat-controlled Senate. Meanwhile, the economic calendar saw a record 10.1 million job openings, trouncing estimates of 9.1 million. Tuesday's NFIB Small Business Index fell after last month's post-election high. Wednesday's Consumer Price Index came in at expectations with a monthly increase of 0.5%. The muted monthly increase seemed to temporarily support the Federal Reserve's statement of transitory inflation, as the 12-month rate decreased from 4.5% in July to 4.3%. Yet Thursday's Producer Price Index came in with a headline that captured economists' attention. The 7.8% 12-month inflation number represented the highest reading since the index was recreated in 2010. Analysts pointed to sharp increases within the services sector, which accounted for some of the largest increases. The week was closed out with Friday's University of Michigan Consumer Sentiment Index, which dropped unexpectedly. The drop from 81.2 in July to 70.2 in August represents a 13.55% month-over-month decline in sentiment, which took the index back to 2011 levels. What's also noteworthy is that this sudden drop in sentiment has only been surpassed 3 times in the last 20 years, 2 of which coincided with the financial crisis of 2008 and the governmental lockdowns at the onset of the coronavirus pandemic.